In this chart, we are looking at the same price action from two different perspectives, a beginner view and an advanced view. Let's start with the beginner view. A beginner trader usually relies on simple support and resistance levels. Here, the trader sees the price breaking below support and then coming back to retest it. This retest is taken as an entry point for a short position, with the stop loss placed just above the last structure and the take profit set at a 1-to-1 risk-to-reward ratio. This method works, but it is very basic and doesn't take into account the deeper market structure. Now let's look at the advanced view. An experienced trader analyzes the same chart but with more precision. Instead of just calling it support, they identify a break of structure, which signals a shift in trend direction. They also recognize a supply zone where strong sellers previously entered the market. Instead of jumping in immediately, the advanced trader waits for price to return to this supply zone for a more accurate entry point. The stop loss is still placed above the last structure, but the difference lies in trade management. Rather than taking full profit at a fixed level, the advanced trader takes partial profits at structure points and lets the rest of the trade run, capturing bigger moves and improving overall risk to reward. The key takeaway is that both traders are looking at the same chart, but their understanding of price action leads to completely different strategies. Beginners rely on simple support and resistance retests, while advanced traders use supply and demand zones, structural breaks, and dynamic trade management to maximize profits. This is the difference between trading with surface-level knowledge and trading with deeper market understanding. The three drives pattern is a powerful reversal formation that helps traders spot when the market is likely to lose momentum and change direction. It begins with three clear pushes in the same direction, known as drives. In this example, the market makes three higher highs and higher lows, which we label as Drive 1, Drive 2, and Drive 3. Each of these drives shows the market pushing upward, but with each move, the strength behind the trend begins to weaken. After the third drive, traders look for confirmation that the pattern is complete. This confirmation comes when price breaks below the low of the second drive, signaling that buyers are stepping back and sellers are beginning to take control. That's the point where a short position can be opened. Once in the trade, profit targets should be placed at key levels formed during the structure, usually where higher lows acted as support. The idea behind this setup is that after three strong pushes, the market tends to exhaust itself, making it a high-probability opportunity to catch the reversal early. By identifying this pattern and following these steps, traders can enter with confidence, manage risk, and secure profits at the right levels. This image explains a price-action trading strategy called the sniper entry using supply and compression. The strategy is designed to help traders catch high-probability entries in the market by focusing on supply zones and rising wedge formations. The process starts with Step 1, where you identify a distribution phase on lower time frames, which signals that sellers are becoming active and supply is building. Step 2 involves waiting for the price to retest the supply zone, an area where sellers previously dominated, increasing the chance of rejection. During this pullback, the price often forms a rising wedge pattern, which represents compression or weakening bullish momentum. Moving to Step 3, the trader has two entry options. Either enter a sell trade directly when the price touches the supply zone, or wait for confirmation through the breakdown of the rising wedge. Finally, in Step 4, the take profit target is set at a previous major low, where price is most likely to reach after rejection. This structured approach combines supply zone analysis with price compression to maximize accuracy, offering traders a clear and disciplined entry and exit plan. This image explains a trading strategy called How to Trade Bullish Trend Reversals, which helps traders catch a shift from a bearish trend to a bullish one. The process begins with Step 1, where you identify a bearish trend by noticing that price is making consistent lower highs, LH, and lower lows, LL. Once this trend is confirmed, you move to Step 2, which is drawing a Fibonacci retracement tool from the previous key high to the recent low to mark potential reversal levels. In Step 3, you wait patiently for the market to show a sign of reversal, which is when price forms a higher low, HL, instead of another lower low. This is the first confirmation that selling pressure is weakening and buyers are stepping in. Step 4 is the entry trigger. You open your position when price retests the middle of the channel, aligning with the structure shift. Finally, the target is set at the 1.618 Fibonacci extension level, which acts as a logical take-profit zone. This strategy combines market structure, Fibonacci analysis, and price action confirmation to provide a high-probability entry for traders looking to catch trend reversals. This image shows the main types of trend reversal setups that traders use to identify when the market is about to change direction. The first method is pattern plus breakout, where a clear chart pattern such as the head and shoulders forms, signaling weakness in the trend, and once the neckline or trend line breaks, the reversal is confirmed and price starts moving in the opposite direction. The second method is breakout with lower highs and lower lows, which happens when price fails to make a new higher high and instead forms a lower high, then breaks the previous support and creates a lower low, confirming that sellers are taking control. The third method is called new high fail plus breakout, where the market tries to create a higher high but fails, showing that buyers are losing strength, and then breaks below a significant support zone, often followed by strong bearish momentum. Traders can either enter aggressively at the breakout or patiently after the retest. The fourth method is break and retest, where price breaks through a key support or trend line with a strong bearish move, then comes back to retest the broken level, which turns into resistance, and once a bearish candle forms, it confirms the reversal and offers a reliable entry point. Altogether, these four techniques, pattern breakouts, structural shifts with lower highs and lows, failed new highs with breakout, and break retest confirmations, provide powerful ways to spot market reversals and trade them effectively. This image provides a clear and structured explanation of how to take long and short trading positions using a combination of price action and RSI trendline breakouts. On the left side, long position, the chart shows a downtrend where the price has been consistently moving lower. A downward trend line is drawn connecting the lower highs, and eventually, the price breaks above this trend line, signaling a potential reversal. At the same time, the RSI, Relative Strength Index indicator, also shows a breakout from its own downward trend line while being in the oversold region, below 30. This double confirmation, price breaking above the trend line and RSI breaking out of the oversold trend line, indicates a strong reversal signal. The correct strategy here is to enter a long trade, buy, at the breakout point, with a stop loss placed just below the breakout level to manage risk. After entry, the price rises sharply, validating the setup. On the right side, short position, the chart illustrates an uptrend where the price has been moving higher. An upward trend line connects the higher lows, showing bullish momentum. Eventually, the price breaks below this trend line, indicating weakness. Meanwhile, the RSI also breaks below its trend line after being in the overbought region, above 70, signaling that bullish momentum is exhausted and a reversal is likely. This provides confirmation to take a short trade, sell, at the breakout point, with a stop loss placed just above the breakout level. After entry, the price falls sharply, validating the short setup. This strategy combines RSI trendline breakouts with price trendline breakouts to confirm reversals. A breakout in the oversold RSI region supports a long position, while a breakout in the overbought RSI region supports a short position. By aligning technical signals from both the chart and the RSI indicator, traders can identify higher probability reversal trades with defined stop-loss placements.